Okay, we are back with the Lesson 4 Glossary. Again, there is no quiz on this. Just think it would be a good idea to go over it. And gives you some information as we're looking at the markets throughout the course of the program. And also as we move forward to give you an idea of where we're going to go. A strike price represents the exercise price of an option, the price at which the rights of an option can be exercised into a futures contract. For example, a December $2.40 call has a $2.40 strike price, meaning the owner of the option can buy futures at $2.40 by exercising the call. Which means if the price goes down to $2 in this case, okay, and they have a $2.40 call, the strike price $2.40, then they can go back in time and sell the futures contract at $2.40 and then offset it at $2, which means there'll be a 40-cent gain minus commissions, and the option will have increased or will have increased in value about 40 cents plus or minus, depending on time value, etc., which we talked about. If it goes up to, say, you have the $2.40 strike price, it goes up to $2.60, it's not going to be worth anything, because then you just lose your premium and sell the grain at $2.60. A tender announces the intention of delivering a commodity or intent to buy. The tender usually spells out delivery details, etc. Overseas buyers usually issue tenders to ensure the maximum competition for a given piece of business. A Texas hedge, which you'll hear about some as being long or short futures in an amount more than you physically owned. An example: selling $20,000 or 20,000 bushels worth of grain on the futures market when you only actually have 10,000 bushels. It's a Texas hedge. Farmers usually just offset what they have in physical commodity. When you go above what you actually have, you are no longer being a marketer and being a hedger. You are being I hate to call it an investor, but you're being a risk taker, and you're putting up money with the idea that there's a certain amount of risk, and you hope to make money off of that. Time decay is the decline in time value portion of any options premium over time. This assumes the underlying futures price remains constant. Now, anytime you buy an option, let's just say you want to put in a $5 put, and you're expecting prices to go down to $4.50. The difference between the $5 put and then the exercise price of $4.50 is $4.50. However, other people are likely also going to think that the market's going to go down, and so there is value there in addition, so that instead of costing you 50 cents, it may cost you 70 cents. But over time, that amount will decay, and it will become closer to the actual 50 cent. It can work either way for you or against you in terms of time decay, but that's what that's about. And time value is the amount of an option premium that's not immediate exercise value. The example here, a December futures closed today at $2.92. The $2.80 call closed at 18 cents, and 12 cents is the exercise value. So the time value is 6 cents per bushel, basically. Underlying futures contract, we've talked about that. Going back to the Anderson's group, here we have May 12th. Let's go say we're in February. So the underlying nearby futures contract is March 12th. If you sell grain for fall delivery in 2012, the underlying contract would be December 2012. Okay, and finishing this up, volatility, generally the degree at which a price will change in the market. In options trading, refers to a specific measurement where they actually measure volatility. But those changes, a lot of people get upset about it and thinking there are too many investors in the market making prices go up and down, but prices going up and down are actually opportunities for farmer. It causes volatility, which creates opportunity if farmers and landowners take advantage of it. But that's what volatility is, the amount of degree of price change, and the more uncertainty there is in a market, weather, production, etc., the more volatility there will be, the more risk, the more potential revenue possibilities. Okay, and the next lesson, just simply due to timing, and I don't like jumping around, but we're going to have a brief lesson on crop insurance, just simply because that is the time of the year that we're in to be looking at crop insurance, and so it's a good idea to get that out now for those of you who will need crop insurance to protect your crop, or you want to know what your farmer can do and why they can protect their position with federal crop insurance. Phone number, give me a call, 217-377-3201, and email is kwbrooks@bksolutionsonline.com. And we will see you next week with a brief lesson on crop insurance. For those of you who are already enrolled in the Farmland Owner program, it'll be much the same, with maybe a little bit harder look at how crop insurance affects the marketing plan. So we will see you next week. Bye.